Hey, it's Mike Rowe, and it just occurred to me that ZipRecruiter has been sponsoring my podcast, The Way I Heard It, for the last 10 years. Consequently, I've agreed to sing their jingle at the end of this commercial in 4-part harmony, all by myself. Why would I do that? Because years ago, when the MicroWorks Foundation was expanding and I was desperate to hire a few uniquely qualified individuals, I posted a job for free on ZipRecruiter, and I found the people I was looking for in less than 24 hours. It's that simple. Ever since, I've been telling my audience that ZipRecruiter got me the most qualified, most interested people. And now I'm telling you. Post a job for free at ZipRecruiter.com/zip and watch what happens. That's ZipRecruiter.com/zip. And now, here's their official jingle in 4-part harmony.
Build your team, build it sooner. Meet your match at ZipRecruiter. Try it free.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
This week marked an, rather inauspicious milestone for the United States. It hit $40 trillion in government debt. Now, that kind of, to some, came out of the blue. Up until that 40 trillion mark was set, didn't seem like anybody's really paying attention. 39.99 trillion didn't seem to matter. But when 40 was reached, it was kind of like a birthday. Whether it was a 0 or a 5, it seemed to take on more importance. Showed up in the bond market, the Treasury market, where the U.S. government goes to borrow. We saw a spike in Treasury levels to yields not seen in 20 years. That, combined with worries about inflation, the amount of debt and borrowing that artificial intelligence companies are doing right now, has just seen the bond market kind of explode with supply, and investors are now demanding a bit of a risk premium. That's all sent bond yields, Treasury yields higher, and potentially could raise borrowing costs for everyday consumers through mortgages or auto lending or what have you. Now, from the U.S. government's standpoint, specifically that of U.S. President Donald Trump, he seems to think that despite the burgeoning debts, the U.S. should actually be paying the lowest interest rate available.
Now when we announce good numbers, the better they are, the worse it is for interest rates. So we could have a GDP of 10 times. You know, they say, oh, it's going to be 3 times or 4.1. We could have a GDP of 10, 12, 15 times if they just leave us alone. Let the rates go down. We should pay the lowest interest rates. You know, every point of interest is $600 billion. Think of that. 2 points means we make a fortune, but we keep driving it up. It's a very unfair system, and I've said it now for a long time. When our country does well, interest rates should go down. I mean, every time I hear our country's doing well, I say, oh, it's too bad, because they lift up interest rates. They should drop interest rates because it means we have a strong country, and it's all based on credit, meaning good credit, and we have the best credit. Does that make sense to anybody? I mean, it seems pretty simple to me, but it's a killer. You know, I almost like to hear bad numbers. I'm saying, I hope we have bad numbers today. Interest rates will go down. It doesn't make sense.
That's not exactly how the bond or Treasury market works. Investors look at the specifics of what's going on for debt and borrowing and demand and supply, and they adjust their demands for yield accordingly. It came to a head this week with that as the U.S. Treasury, led by Treasury Secretary Scott Bessent, announced plans to actually have the government buy more bonds to alleviate some of the offset the demand and supply risk and bring yields down. Worked for about a day. So we'll see where this goes. They've also planned this through the election cycle leading up to the U.S. midterms. Welcome to In This Economy. I'm Mike Eppel, and joining me on the line is Tiago Figueiredo of Desjardins, macro strategist at Desjardins Financial. What was your takeaway from what we saw this week? I mean, as you heard in my intro, it didn't seem like anybody was paying any attention until 40 trillion was the eye-watering level of U.S. government debt, and then all of a sudden, everybody kind of started to freak out a little bit. Do you think that was part of it, or was it just kind of an entirety confluence of events?
Well, I think that the 40 trillion number was a bit of a wake-up call to some folks, but those who were kind of looking under the hood, you could kind of see that bond investors were already starting to demand more compensation for holding, particularly the longer duration bonds, and that's been a trend that's been going on for some time. So this concern about debt dynamics and debt sustainability uh, has always been there. But I do think that the 40 trillion number is a headline that's is garnering a lot of attention, and people are definitely more aware of it if they weren't looking at it before.
Well, the U.S. has always been seen as, the bellwether, the U.S. dollar, the king of all currencies.
Mhm.
When we're in this situation, when they're in this situation, and by the way, I don't want to just put it all in the U.S. because let's face it, Canada's burgeoning debt load is what, north of 1.3 trillion now. So we're not, living in glass houses, I suppose. But, from an investor standpoint, they've already had their credit rating downgraded to AA plus. Are they that shining beacon on a hill, or should investors be, do they have the right idea to look elsewhere when they're looking at the credit markets?
I think the hard reality is that it's very hard to replace the US just because of the sheer size of the market. What we've been hearing, and we largely agree with this, is people share that view that, the US is maybe no longer as much of a shining star as it once was, but actually putting dollars to work elsewhere is challenging, both from the idea that the size of the market is much smaller, but also concerns that if we do have some large shock, that that those other markets won't provide as much of a hedge as U.S. Treasuries would. We kind of got to take that during, you know, uh, the escalations in the Middle East, where we had U.S. Treasuries outperforming, government of Canada bonds and across other markets in Europe as there was more exposure to energy prices. I think that that's still a concern. What we have been seeing is that there's definitely a bit more desire to hedge U.S. dollar risk. So the idea here is that before you had a U.S. dollar that would generally offset any declines in risk assets, it now seems to be that the U.S. dollar is much more correlated during periods of so much more correlated with riskier assets. And so when we get these periods of turmoil, you're not getting that much of an offset.
In historical terms, I was looking this up. When the last time the U.S. government actually had a surplus, I was back when Clinton was the president, and they actually paid down a little bit of debt. But since 2020, they've added 68% to their debt. Okay, COVID, sure, absolutely, huge spending, get that. But has the Trump administration lost credibility? Because the whole idea when Trump came into office was Doge, cutting government spending, and yet in all, he's just piled it on to the nth degree. Starting a war in the Middle East, not the best strategy when you're trying, if you think you're somehow going to reduce government debt loads.
Yeah, I agree with you. I do think that that there's definitely a bit of a credibility concern in the U.S. now. There's also a lot more concern about institutional independence as well. And again, those are all reasons that are kind of leading investors to start to think about allocating dollars elsewhere. Again, it's just that tough part that right now it's still the case where the U.S. economy is just so large that you can allocate maybe a bit of the marginal dollar elsewhere, but it's been challenging. One of the things that we've been flagging is actually that Canada seems to be benefiting from this. So despite the fact that from an economic standpoint, and there's definitely certain pockets of the economy that are getting hit very hard from the trade tensions with the U.S., from the financial perspective, Canadian assets have actually benefited here. We're seeing a lot of international demand for Canadian bonds. Even domestic investors are starting to buy more Canadian bonds. And from the equity side, the amount of buying that we've been seeing from mutual funds and ETFs for Canadian listed stocks, ETFs, and has been very impressive this year. And again, I think this is just a function of investors were generally overweight the U.S. At the margin, we're starting to see less money going into the U.S. and a bit more going to places that are perceived to be a bit safer and against this backdrop.
were your thoughts on Besant's announcement to ostensibly, try to bring long-term yields down? Yeah, they're going to ramp things up with the bond buying, but I don't know. I took that as, for the bond vigilantes out there, they're going to pressure. They're not going to stand by on the wayside and go, okay, sure.
I think it's one of those that it has the potential to create a bigger credibility problem from the U.S. Treasury. And at the end of the day, you have to think about like why were investors concerned about owning longer duration bonds in the first place. It's a supply story, and yes, doubling the base of buybacks can help offset that, but it doesn't remove the fact that hyperscalers are still a much larger chunk of the market than they once were. Uh, the debt sustainability dynamics in the U.S., no real indication that those are going to change anytime soon. So that upper pressuring yields, I think this was a temporary relief that kind of, as you mentioned in your intro, we're already seeing some of that unwind. And, my idea here is really that going forward, I think that the Treasury might look to issue maybe a bit less on the long end of the curve and try to shift the issuance profile to try to accommodate this new supply that we're getting from hyperscalers, which is likely to persist into 2027. But we'll have to wait and see what the Treasury Secretary ultimately decides.
Sidebar to all of this, or adjacent, if you will, is what does the U.S. Fed do next? I mean, Warsh, all Trump ever talks about is cutting interest rates. Warsh kind of played that really close to the vest in his confirmation hearing. He's been really vague about any forward guidance. The last meeting, it looked like some on the FOMC wanted to raise rates. Does the Treasury activity change the dynamics for the September meeting?
I don't think the Treasury activity changes the dynamics per se. Like our view has always been that the inflationary pressures that we've been getting have been difficult to parse, but ultimately should be one-off increases for the most part. So while the market was pricing in more and more rate hikes earlier this year, particularly post the escalations of the Middle East, we were largely in the camp that the Fed was likely going to remain on hold for the remainder of the year. I think that that's still the case. It's definitely been working in our favor given the recent labor market data and the reasonable inflation print that we've gotten for July. So we'll our view is still largely that the Fed remains on hold here and that inflation gradually starts to normalize. I mean, what we did get from the last FOMC meeting was that there's obviously a much more concern about inflation. That's not too much of a surprise. But I do think that the meeting minutes that we even got yesterday are a bit stale in the sense that the latest string of economic data does point to inflation at least not accelerating from here.
Well, the argument for rising inflation risks has been what's been going on in the oil trade, but that really hasn't spilled over to a lot of other sectors of the economy. And I'd argue that, okay, raising interest rates does not do anything to cool down energy or food prices. Those are things you need to buy one way or the other. You really can't afford them. Discretionary items, sure. But, so does this bring it back to, well, the core rate's fine. And like you say, the U.S. economy has not been doing well. They lost jobs in the latest month, and the GDP is kind of mediocre at best. So why wouldn't the Fed stay on the sidelines? I just don't see them raising. That's just, despite what some think they're going to do.
Yeah. What I'll say is that the labor market, I think, is not going to be a source of inflationary pressures, or at least it does not seem to be a source of inflationary pressures right now. A lot of the growth that we're seeing in the U.S. is driven by the AI infrastructure build-outs. I think that's likely to continue. But one thing that we were a bit surprised with is how resilient consumers have been. And I mean, lots of people have made the comments that there's definitely a spread between, different income quintiles and how that spending is being spread out. But I mean, overall, I think that growth is pretty healthy in the U.S., but it's not. Again, I don't think it's the kind of growth that's going to necessarily boost inflation at this point. And I think, if the employment side of the mandate isn't putting inflationary pressures, and inflation itself slowly starts to normalize, I think that the base case should really be that the Fed doesn't really need to act on this. Another thing that I wanted to flag here is really just there's a few changes that are coming through to how the Fed is measuring inflation, and we also have to keep an eye on what all of these task forces, the conclusions that they draw when we get closer to the end of the year. Even if in the FOMC meetings minutes that we got yesterday, it seemed like Warsh was already making comments about potentially lowering the amount of Fed meetings from 8 to 6, with the idea being that you get more information to gather, you got more time to gather information, then you can actually have something to say at these meetings. So I think that we're going to get a lot of changes towards Fed communication come next year. I don't necessarily think that that's a bad thing. It could be a good thing. We really have to wait and see.
And that was Tiago Figueiredo, macro strategist at Desjardins Financial. My name is Mike Eppel. You've been listening to In This Economy. Hey, we appreciate your feedback. You can send me an email at mike.eppel@rci.rogers.com, or on social I go by @Eppman, EPPMAN. We'll talk again soon.